Imagine waking up tomorrow, checking your banking app, and discovering that your bank no longer has your money. Not because it was stolen, not because hackers attacked it, but because it was never sitting there in the first place. Every time you deposit money into a bank, something incredible happens. Your money immediately begins working for someone else. It could be helping a family buy their dream home, funding a new business. Meanwhile, your account still shows the exact same balance. It almost feels like magic, but it's actually economics. To reveal exactly how owning a bank can generate billions of dollars every year. Ask someone, what does a bank do? Most people would probably answer, it keeps my money safe. And they're not entirely wrong. Banks do protect your money. They process payments, store deposits, offer loans, issue credit cards, and help businesses move billions of dollars every single day. But none of those services explain why the world's largest banks are worth hundreds of billions of dollars. Because here's the surprising reality. Banks don't become rich by storing money. They become rich by putting money to work. Think about a warehouse. If products simply sit on shelves forever, the business makes nothing. Profit only happens when those products move. Banks operate in exactly the same way. Money that sits still makes very little. Money that moves creates wealth. And banks have mastered the art of keeping money moving. Let's imagine you decide to open your own bank. On your first day, hundreds of people walk through your doors. Some deposit $500. Others deposit $10,000. Businesses deposit millions. By the end of the month, customers have trusted you with $100 million. At first, that sounds like you've just become incredibly rich. But here's the catch. That money doesn't belong to you. Every dollar belongs to your customers. Whenever they want it back, you have to return it. So here's the question. If the money isn't yours, how can owning a bank become one of the most profitable businesses in history? The answer is surprisingly simple. Banks don't sell products. They don't manufacture cars. They don't build smartphones. Instead, they sell something far more valuable. Access to money. Let's go back to our bank. Emma has just deposited $1,000. She walks out of the branch, checks her banking app, and smiles. Her balance still says $1,000 available. As far as she's concerned, nothing has changed. Her money is safe. Or at least that's what she believes. Because the moment Emma's deposit reaches the bank, something happens behind the scenes that almost nobody ever sees. The money doesn't simply sit inside a giant vault. Instead, it enters a massive financial system designed to keep every dollar moving. And that's where banks begin making money. Hollywood has convinced us that banks are filled with enormous vaults, stacked floor to ceiling with cash. And yes, banks do keep some physical cash on hand, but only a tiny fraction. Why? Because storing money doesn't create profit. Imagine owning a taxi, but leaving it parked all day. It stays perfectly safe, but it earns absolutely nothing. Banks think the same way. Instead of locking money away, they lend it to people who are willing to pay for the privilege of using it. That payment is called interest. And this tiny percentage is the foundation of the entire banking industry. But here's where it gets really interesting. Emma still believes her $1,000 is simply sitting in the bank. But at the very same moment, a young entrepreneur is applying for a business loan. The bank reviews the application, verifies the numbers, calculates the risk, and approves the loan. Where did the loan money come from? It wasn't created from thin air. It came from the pool of deposits, including Emma's. Emma still owns her money, but the bank temporarily puts it to work. The entrepreneur opens the business. Customers start arriving. Revenue starts flowing in. Every month, the entrepreneur makes a loan payment. Part of that payment repays the original loan. The other part is interest. That's the bank's income. Repeat that process thousands of times, every single day. And now you're beginning to understand how banks really make money. But banks don't keep every deposited dollar in circulation. They always keep some cash available, because customers withdraw money every day. Imagine if everyone showed up tomorrow, wanting all of their money back. The bank couldn't do it immediately. Not because the money disappeared, but because it's already working throughout the economy. This is why confidence is everything. As long as people trust that they can access their money whenever they need it, the system works. That's why bank runs can become so dangerous. Fear spreads faster than facts. More people rush to withdraw, which creates even more fear, creating a vicious cycle, which is exactly why modern banking regulations exist. Governments learned this lesson the hard way. Throughout history, financial panics repeatedly showed that trust alone wasn't enough. Banks needed rules. They needed reserve requirements, capital requirements, liquidity requirements, and deposit insurance. Together, these protections help keep confidence alive. So the next time you check your bank balance, remember, you're looking at only one small part of an enormous financial machine. Every deposit helps someone borrow. Every loan creates opportunity. Every interest payment keeps the entire system running. And that's how banks make billions. Not because they own everyone's money. The money in your account that is doing far more than simply sitting in a vault. It's helping build businesses, finance homes, create jobs, and quietly powers the economy every single day. That's the invisible business hidden behind every bank account. And now you know how banks really make money. Thanks for watching.